Welcome to a crucial discussion on the hidden economic crisis in America. This presentation is brought to you by Higgins Capital. In the land of opportunity America, a hidden economic crisis is silently unfolding, lurking beneath the surface of our everyday lives. As we navigate through the hustle and bustle, we may overlook the subtle signs that point to an escalating economic quandary. One of the main contributors to this crisis is the mounting level of debt. Our nation's debt has been steadily rising, a trajectory that shows no signs of slowing down. This increase in debt isn't just a number on a spreadsheet, it's a ticking time bomb threatening to destabilize our economic foundations. Then, there's the specter of high inflation. It's not just about paying a few extra cents for your morning coffee, it's about the eroding purchasing power of the American dollar. About families struggling to stretch their paycheck to cover basic necessities. It's about the widening gap between the rich and the poor, the haves and the have-nots. Compounding these issues are higher for longer interest rates. This means borrowing becomes more expensive, slowing down investment and growth. For businesses, it could mean less profit. For individuals, it could mean less disposable income, less savings, and more financial strain. Lower future earnings present headwinds for stocks, making the market a turbulent sea for investors. Even the seemingly stable sectors like corporate credit events and commercial real estate are not immune to this crisis. In these uncertain times, it's prudent for investors to diversify into inflation-resistant assets such as global markets, defensive stocks, and U.S. Treasuries. Keeping debt levels low is also a wise strategy. The government's response to these issues is pivotal. It needs to address inflation, reduce the deficit, and support the economy without exacerbating the debt burden. Now, let's delve deeper into each of these factors to understand their implications. The first aspect of our discussion is the growing burden of rising debt. This is not just numbers on a spreadsheet, but a looming storm cloud over the economy, affecting both individuals and corporations alike. What happens when debt grows at an unprecedented rate? Well, it's like a snowball rolling down a hill. It keeps getting bigger and bigger until it becomes a veritable avalanche. And this avalanche doesn't just impact the average Joe or Jane, it also hits corporations hard. As companies take on more debt to finance their operations and expansions, the risk of default increases. This is particularly true when economic conditions are unfavorable, as they are now. Now let's turn our attention to the stock market. Lower future earnings are a significant headwind for stocks. When companies are saddled with high levels of debt, their profitability can be significantly impacted, which in turn affects their stock prices. It's a domino effect, one that can send shockwaves through the financial markets. And what's at the epicenter of this potential financial quake? The commercial real estate sector. High levels of corporate debt, coupled with an uncertain economic environment, can trigger a corporate credit event. This could result in massive losses for companies and, by extension, their investors. With this debt comes the risk of a corporate credit event, especially in the commercial real estate sector. Next, we address the threat of high inflation. Often perceived as the phantom menace of the economy, inflation is the general rise in prices over time. It's like a silent burglar, sneaking into our homes and quietly eroding the buying power of our hard-earned dollars. One day you're buying a cup of coffee for $2. The next, it's $2.50. That's inflation at work. It's not that the coffee is better or that the beans are rarer. Instead, the value of your dollar has decreased. But why does this happen? In essence, it's a delicate balancing act between supply and demand. When the economy is booming, demand for goods and services increases. But if the supply can't keep up, prices rise. That's inflation. The Federal Reserve, or the Fed as it's commonly known, plays a crucial role here. It's like the conductor of an orchestra, setting the tempo and ensuring all parts are in harmony. The Fed uses interest rates as a tool to keep inflation in check. When inflation starts to heat up, the Fed can raise interest rates to cool things down. However, there's a catch. Higher interest rates can make borrowing more expensive, which can slow economic growth. It's a tricky tightrope to walk, and the Fed must be careful not to tip the balance. As inflation rises, investors need to diversify their portfolios to hedge against these economic fluctuations. Diversification is key in these uncertain times. A statement that rings true, especially when navigating the tumultuous waters of an economic crisis. The question is, how exactly do we diversify our portfolios to weather the storm? To answer that, let's start with a fundamental principle of investing. Don't put all your eggs in one basket. This adage is particularly relevant when it comes to inflation-resistant assets. By spreading investments across different asset classes such as global markets, defensive stocks, and U.S. Treasuries, we can potentially mitigate the risks associated with an economic downturn. Global markets offer a world of opportunities, quite literally. Investing in international markets may provide a buffer against domestic economic turmoil. It's like having a safety net that stretches across different continents, offering a level of protection against the highs and lows of a single country's economy. Defensive stocks, on the other hand, are the stalwarts of the investing world. These are the shares of companies that provide essential goods and services, things that people need regardless of economic conditions. Think utilities, healthcare, and consumer staples. These stocks may not skyrocket in a booming economy, but they tend to hold their ground when times get tough. Then there's the allure of U.S. Treasuries. They're often seen as a safe harbor during stormy economic weather, as they're backed by the full faith and credit of the U.S. government. When other investments seem too risky, U.S. Treasuries can offer a sense of stability, making them a valuable addition to a diversified portfolio. But diversification isn't just about where you invest your money. It's also about managing your liabilities. Keeping personal debt levels low is crucial. High debt can be like a heavy anchor, dragging down your financial ship in a turbulent economy. So, as we diversify our assets, let's also aim to lighten our debt load. While we navigate these economic challenges, the government's response is pivotal. But remember, the control of your financial future ultimately lies in your hands, or rather, in your portfolio. Diversification is not just a strategy, it's a safeguard for your financial well-being. The government's response to these issues can make or break the situation. In the face of an economic crisis, the government's role is pivotal. It's like a doctor diagnosing a patient. The right treatment can bring recovery, but the wrong one can worsen the condition. So what's the prescription for our current economic ailments? Let's break it down. First, we have inflation. It's like a fever, a symptom of a deeper problem that can't be ignored. By adjusting monetary policy and interest rates, the government can cool down the economy and curb price increases. It's a delicate balancing act, akin to adjusting a thermostat. Too cold, and we risk a downturn. Too hot, and we risk spiraling inflation. Next, we have the deficit. In layman's terms, it's the difference between what the government spends and what it earns. To reduce this, the government has two main levers: increasing revenue or decreasing spending. Increasing revenue could mean raising taxes or improving economic growth, while decreasing spending could entail cutting back on public services or investments. However, it's not just about reducing the deficit, but doing so without exacerbating the debt burden. This is where the government's role in supporting the economy comes in. It's a juggling act, promoting growth and employment while managing spending and debt. Potential strategies could include investing in infrastructure to stimulate growth, supporting industries critical for economic stability, or implementing fiscal policies that encourage private sector investment. Each of these strategies has its own potential impacts and trade-offs, and the government's decisions will shape the economic landscape for years to come. In the end, the government's response is one part of the puzzle. As investors, businesses, and citizens, we also have a role to play in navigating these economic challenges. By understanding the situation, diversifying our portfolios, and making informed decisions, we can adapt and thrive. As we face these economic challenges, understanding and adapting to the situation is key to weathering the storm. In conclusion, the hidden economic crisis in America is a reality we must confront. We've delved into the burden of rising debt, the threat of high inflation, and the potential of higher for longer interest rates. We've explored the headwinds these factors create for stocks, the implications of a corporate credit event, and the challenges in the commercial real estate sector. We've underscored the importance of diversifying into inflation-resistant assets, such as global markets, defensive stocks, and U.S. Treasuries, and the necessity of keeping personal debt levels low. We've also highlighted the pivotal role of government response in addressing inflation, reducing the deficit, and supporting the economy without exacerbating the debt burden. In these uncertain times, prudent financial management is key. Adopting investment strategies for this economic crisis, hedging against inflation with real assets, and exploring global macro investments can all help navigate these uncharted waters. Thank you for joining us in this discussion brought to you by Higgins Capital. Stay informed, stay prepared, and most importantly, stay resilient.